great to be here. We had some great conversations in some of those breakout rooms, so lots of questions. And that's one of the main things that I'm here for. I'm going to pitch a little bit of stuff just about real estate investing. We're going to start real slow, talking about net income and what's an expense, that sort of thing. We're going to ramp into personally owned and also corporately owned real estate. So it's going to be fun. So hang on, and let me see. I'll share my screen here. So hopefully you can see that. You can see how clean and lovely my desktop is, right? Keeping a clean desktop is key. So thank you so much for that, James. That was sweet. Let's see, we'll get into our presentation. So about me, I run Frederick and Sherwin. We're a small little accounting firm in Sherwood Park, which is just nestled right next to Edmonton. As you said, business for me runs in the family. I got a granddad that was a CMA, ran his own show. My mom's a bookkeeper. I've been doing this for as long as I can remember, which is, I can't really remember 3 months ago. So that's why I keep really proper bookkeeping, but I've been doing this a while. So I started with Myers Norris Penny. They're a Western Canadian chartered accounting firm. So that's where I got my letters. So I am a CA and now I'm a CPA. After that, I did some work with Stantec, just kind of running around North America and financially evaluating some of the businesses that they're buying. So mergers and acquisitions, they're going to buy a business. I'm going to check them out just to make sure, run a little audit on them, make sure all their numbers are good. We found some really fun things there. I did a really, really boring, typical accounting job with All Weather Windows, great company. We had about 20 staff or so in the accounting department that reported to me, and we just did regular monthly old bookkeeping. So keeping really proper records, keeping account of that was a lot of fun. We had a lot of issues that we came up with because that's a multinational firm and a lot of issues that way. And now I've been a partner with FNS, so Frederick and Sherwin, for about 10 years. I think that slide's a couple of years old because it keeps growing that way. So a little bit about Frederick and Sherwin just to get you started. I just thank you to the Mogul team for inviting me here. So we are kind of separate. We are an accounting firm, a small accounting firm. It's just two partners here. It's Jake Frederick and myself, David Sherwin. We've got about 4 staff and we like to keep it quite small and tight that way. We love our client relationships. That's why we're here. We actually don't have one of those nasty billable hours that we were talking about earlier. We don't charge on an hourly basis for the majority of our work. I encourage our clients to call us. I want to hear their questions. I want to deal with their questions when they're thinking about them or when they're buying that truck or buying that real estate or whatever. I want to get involved and answer their questions and make sure that things are set up correctly. So we really encourage our clients to kind of reach out to us and ask us. And then, when we're actually billing, we do a quoted system. And so depending on what we're filing, if we're filing corporate taxes or personal taxes or just a little real estate piece or whatever, we'll quote you on that. And that's where we bill at the end when we're actually filing some tax work. So we do also just have a bunch of easy sort of invoicing options, monthly accounting fees, that sort of stuff. So we can set those up depending on our clients. But what we really focus in on, we're here all year round. We're here to answer all those questions. We focus in on those tax preparation forms. So filing personal taxes, filing corporate taxes. And then what we really focus on is the tax planning between a corporation and a personal tax, right? So when we've got this corporate income, we're going to send that corporate income over to the personal. That's what tax planning is, and it's really big for us, and that's where we save a lot of big dollars. On the personal side, we can also save a lot of big dollars just by getting organized or making sure we're deducting things correctly, that sort of stuff. So we'll talk about that. One thing I just want to say, I just loved the presentation before. That was awesome. Just keeping things organized, having a file structure and having everything in the cloud. So we are accountants here. I've got my multi-screen set up because I need a lot of real estate for all these documents I'm looking at. We work in the cloud. We've got a secured cloud for all our documents, and file naming for us is super key. I actually have a folder and it's got every single one of my client files in it. I think there's about 370,000 files in this one folder on our Mac, and that's synced up to our secured server online on the cloud. So I can get access to it at home or when I'm on the go. When my client calls me, I want to make sure that I can bring up their exact financial statements immediately. So I've got their client code that I can type in. It's going to come up. It's all organized by client code, then by year, then by working paper or whatever it is. And I can get into those financial statements, probably about in under 2 seconds for every single one of my clients. But file naming is so key there, because we got 6 or 7 staff all with their little fingers in this, what we call our bin of client work of 370,000 files. So file naming for us is super key. So that's a little bit just about how Frederick and Sherwin works. We got to be working in this digital realm. We get a lot of paperwork in here, but it 100% gets digitized and added to that bin. So let's talk about real estate now. Enough about me, enough about all that sort of accounting stuff. Real estate, this is the fun stuff, right? So one other thing about me, I guess just a little bit by experience. So I'm invested in properties. I love properties. I'm invested corporately and personally. It depends on what's happening there. So we're going to talk a lot about those. We've done 2 flips. I've got 1 long-term rental right now, and I've got a short-term rental on the go, which I'm super excited about. That one is, we've got an accepted offer on it. We'll figure out what we're doing next Friday. So looking forward to that. But real estate has always been a huge passion of mine. So to start off really sort of basic, I'm going to talk about net income, and so income minus expenses, we're going to come down to net income. And whatever that net income is, that's what we get to basically tax plan on, right? So this, one of our most basic questions that we get all the time is like, hey, is this an expense? Can I write this off? What is a write-off, So what qualifies as an expense? And the Income Tax Act, because that's like the most, what we have to rely on, the most boring read you'll ever do, basically talks about an expense as a cost incurred to either to generate or to potentially generate income. Okay, so an expense is a cost incurred to generate or to potentially generate income. And so that's the baseline of, is this an expense or not? So did you buy that haircut well, I need to look good, to sell real estate. Well, you guys all look great, so that's good. You got that covered. But, I need this haircut to look good. And Siri is going to say, well, actually, you could look good or you could look like crap, and that's not going to generate or potentially generate income. So they actually deny that one. But what about advertising? I'm going to throw a bunch of money at a bus stop or Google SEO work. It's not going to generate income, but it might potentially generate income. So yeah, advertising expenses are going to be a proper expense. Office expenses, things you buy at Staples. What about, we get this question, I've got 1 rental property and I needed to buy an iPad in order to expense it. Well, how much are we using that iPad for? What's our intention for that iPad? Is it 100% business asset? Who knows? These are questions that we got to kind of dial down. Condo fees, property taxes, those are obvious expenses. Lawyer fees, unfortunate accounting fees, management fees, insurance. These are all expenses, and it's a great thing to open up this spreadsheet from this presentation and really go through each one of those sort of columns and think about, okay, what could I add into here? What about my cell phone? Can I deduct that as a real estate expense? I need it, I use it. Well, let's talk to your accountant. Let's see what we can deduct there, right? Now, mortgage payment, we talked about that. We've got a lot of clients that will come in and be like, well, I'm cash flowing $100 here a month. So things are pretty good. So I've got $1,200 in income, and so taxes shouldn't be that bad. Well, yeah, but your mortgage payment is $1,500, and these days only $200 of that is interest. So we've got, we're cash flowing $100. We've got $1,300 other dollars of income there. A mortgage payment, the principal payment of that mortgage payment, is just basically reducing debt. It's also reducing cash. Those are 2 balance sheet things. The interest is the income statement portion of that. So only the interest is going to deduct those things. So on those annual returns that the bank will give you, take a look for that interest expense. If you're paying property taxes in there, we also need that number. You can add that into your spreadsheet. If you've got insurance in there, that's a horrible level of insurance, and you should talk to an insurance guy and get better insurance, but you might have an insurance expense in that mortgage payment as well. So take a look at those, but basically the principal portion, as we know, can't be deducted. Okay, repairs and maintenance. This one is huge and it gets messed up all the time. And we've seen where CRA will deny repairs and maintenance. So repairs and maintenance is a fun one because it can be a super big dollar item, right? So what about taking a $15,000 roof replacement and deducting that? Is that just a straight expense? It's a whole roof. It's a 30-year shingle roof. Yeah, well, if it's replacing 30-year shingles, maybe it's an expense. It's repairs and maintenance. We're just replacing it with the same thing. What if we spend 20 grand and we deduct a tin roof instead? Well, now we're going to a lifetime roof, or maybe we're going to a rubber roof or something like that. Now we're extending the life of it. Now it's more of a capital expense. So that's not going to get deducted off our income. What if we just bought a property and it's a foreclosure, and these carpets, my goodness, what a mess, right? We can't even show tenants in this place. Let's replace these carpets for 5 grand. That's an expense. That's just repairs and maintenance. It's just carpets. Actually, CRA says no. When we're buying an asset and we're getting it ready for market, those costs are all capital. So what we might tell a client is be like, can you just show them with these carpets? And then maybe in like 3 months or a year, we'll replace these carpets for the same 5 grand. Then it's an ultimate deduction right away. We don't have to capitalize it. When we capitalize something, we just add it to the asset pool, and then we take a percentage of that capital and we amortize it, right? So if we've got this $5,000 repair for carpets to make this thing brand new, so we had to capitalize that, then we're only taking 20% a year. So we're only deducting $1,000 a year off that carpet. It's going to take us quite a few years to kind of recapture the tax there on those things. Now, last one here, just around net income, and another like huge area where I see a bunch of problems is depreciation or amortization on a property. So what's going on here? We buy a $500,000 house. Okay, when we buy a house, we get to capitalize the investment that we bought, right? But CRA actually makes us allocate a portion of those proceeds. So what we want to know is how much the land is worth. Maybe the land's worth 100 grand. We would want to know how much what we could do, I guess. By tax law, we could state that our fridge is worth this and our dishwasher's worth that and our boiler's worth this. And we can capitalize all those appliances as well. I wouldn't suggest it, but we do need to capitalize a portion of land because that just gets dealt with for tax differently. So say we got this $500,000 property, 400 grand is going into the house, 100 grand is going into land. The actual house portion, the building value of here, we can depreciate. It goes into class 1 on schedule 8, our CCA class, and we get to depreciate it at 6% per year. Now, this is typically, I'm going to say 95% of the time, a horrible idea. And you're like, well, why? We're just generating more expenses here. We take this $400,000 house at 6%. That's a $24,000 write-off this year, right? Well, yeah, that's great. And we actually, get to deduct that house or that expenses, and we can kind of either almost declare a loss or negate our income and not pay any tax on it this year. Yeah, okay, I get it. But 10 years from now, we've now deducted this house at $24,000 a year. Now our book value of this house is 200 grand. Right? And 10 years from now, we're selling it. It's now worth 600, let's say $1 million, but it's worth 600 grand. So we went from 500, 400 for the house, 100 for the land. Now our house is worth 200. So in those years, yeah, we didn't pay any tax because we amortized the house. Good job. When it comes to selling it, now we've got this book value of 200 grand. We actually have a recapture of amortization. So we've got to so of those 600 grand proceeds or $1 million, most of that is going to recapture this depreciation. It's going to bring it back from $200,000 to $400,000. And then anything in addition that we sold it for is capital gains. That recapture of amortization is a one-time hit of taxable income. And then anything from that 500 to that 600, that's all capital gains. So that $100,000 that we made there, that's going to be capital gains. Right now, our tax rates are at 50%. Those can change any year, and the government's really been, forced into a deficit lately. So capital gains rates may change. That's all I'm going to say about that. But so now we've got this $200,000 recapture of amortization. We've also got another 50 grand worth of capital gains, and then we've got a job and we're making 120 grand or 150 grand. Well, now with our rental income and our recapture of selling this house, we've actually got a $400,000 taxable income this year. We're getting charged tax rates of 48% on some of that. Thank you, Trudeau. And so we're into mega tax rates, right? So it's something that we really want to stay away from. There is reasons why we would amortize property. Talk to your accountant and just make sure we're doing it right there. Okay, so talking about personally owned real estate. Because one thing I do want to talk about is when we buy a property, we have this option of incorporating a company. We could incorporate a real estate investment company, which is, they're all the same. It's just what we deem it's going to be doing. So this real estate investment corporation, or we own this thing personally. And if it's just one property or if it's just real estate, we're going to get into the tax differences of the two. But if we own it personally, it's fairly easy and basic. Your personal name goes on title. When we make rental income, we add that rental income to our already employment income or whatever sort of income you have. So let's say you've got $50,000 worth of employment income. After we determine what that net income is, say it's 10 grand, we're going to take that you're already at this $50,000 level by adding to that T776 form using your beautiful spreadsheets. We're going to now have $60,000 worth of taxable income. That extra 10 grand is at this higher tax rate. It's in this 30.5% tax rate. So we can expect that if we get 10 grand worth of taxable income from our real estate when we're making already 50 grand, it's going to cost us $3,050. Okay, over 90, that slide's old too. Over 98,000, it's going to cost us $36, and then on and then on and then on. And as our tax income goes up, so does that marginal tax rate. Okay, so if you've got questions as to what tax rate you're in, just reach out and we can help you identify what we're into, especially if you've got a property that's just crushing it on Airbnb and you got way too much cash, don't know what to deal with. Year-end dates, due dates, it's all pretty basic. We've got a calendar year end. We've got an April 30th tax filing date and tax filing season. How much fun is that? Okay, so here's tax tip. Allocating this rental income between you and your spouse. So if we have a married couple, or we've even got a partnership going on, we can allocate this income to different tax earners, right? So why would we want to do that? Well, we've got maybe one spouse that's making nothing or making 20 grand. We've got another spouse making 150 grand. So we would want this $10,000 worth of rental income to be allocated to that lower income earning spouse, right? So that we can be in this, 15 or 25% tax bracket instead of the 39% tax bracket that high income spouse is paying in, or same with partners. We can split this the same way. When it comes down to this, we're allowed to do this on an annual basis, but don't. The difference in changing who you're allocating this income to every year will trigger 100% trigger an audit, and you're not going to be able to prove why you're changing your percentage allocations on a year-to-year basis. I guarantee you just don't have the paperwork or the support to do that. So, but when you originally purchased the property, that's the best time to determine where we're going to allocate this income. And we want to allocate it to a lower income earning spouse over the next 10 to 30 years that we own this property. So do some tax planning as to where our income's going to be, right? On that initial investment, ways to get this into the lower income earning spouse would be title, only having it in the lower income earning spouse's name. Intention for profit, or where the money came from as well. Let's say this is all spouse's money. If spouse got an inheritance, wants to invest that inheritance, that would be a perfect reason to allocate this income to the lower income earning spouse. Also, the spouse is doing everything on Airbnb, or the spouse is doing everything with the tenants, all the repairs and maintenance, everything is done with this lower income earning spouse. So let's prove that with paperwork, have that document sort of ready for CRA to show that our intention is that high income earning spouse is completely out of this. This is low income earning spouse's investments, and it's their baby. They can do whatever they want with it. So that's just an option there. Hopefully we can kind of tie into a lower income earning spouse, but once we set it, we got to forget it. So if we set that allocation in a random percentage of 12.5% to her and whatever 35% to him, and whatever math works to that person, we got to keep going with that unless there's been an actual change. If there has been an actual change, we can change that allocation. But anyway, enough on that. Other things is just around personally owned properties, or actually any owned properties, corporately or personally. If we rent it out just for a majority of its lifespan, and we end up selling it at a loss, so something like a flip, right? So if we just take a flip and we build it up and we spend a bunch of money on it, and unfortunately we don't make that much money, but if you're with Mogul Group, I'm sure they get this, at least 31%, 31,000 over asking. Is that what you guys sell all your houses for? I think that's what I heard in the Edmonton market, so that'd be good. And but if we do end up losing on it, if we rent it, that terminal loss could be set up and that's 100% deducted, only if it's been rented. If it's not been rented, it was just owned as an investment property or something else, it would become a capital loss. Capital losses can only be tied to capital gains. So we're going to need to do this a couple times to make more money, right? So anyway, just a light thing on sort of terminal losses versus capital losses, but we're not in this to lose money. And so that's enough of that. Okay, let me get my notes here, and I'm just I can talk about taxes for the rest of my life, I'm sure, because I quite like taxes. I like spreadsheets, I like organization. But please send me any sort of questions in the chat. I will get into that kind of at the end here, and then we will have some time for some questions. But our biggest question is why would I incorporate a company, or how do I get this asset from owning personally into a corporation? Why would I do that? So one thing I want to talk about is the different, so in personal land, if it's a flip or if it's a long-term investment, we've got some capital gains, we've got sort of just rental income or even business income, it's all gets taxed at that marginal tax rate. In the incorporated world, it's slightly different. So depending on what we're using this real estate for, is how it's going to get taxed. And those are very different. So the one benefit of having an incorporation is it is a complete separate entity, right? So we've got a legal sort of being for taxes that we can file its taxes with any year end we want. When we incorporate it, we're allowed to determine when that year end is. That year end could be January 31st, could be November 14th, could be any day we want. Now, with that staggered year end, we're allowed to issue a dividend on December 31st, or maybe January 1st, or maybe any day of the year. And now we can take that income in the corporation and push the dividend portion of that into multiple tax years personally. Maybe we want to, we're in this incorporation, we're in this specified investment business, so just real estate. And maybe we're paying 48% tax and we're okay with that. We'll get into the tax rates on 48% tax and why in a minute. Maybe we want to do that for 3 years because we know we're going to have a baby. And so at the end of that 3 years, we could have a baby, our income will be on EI, we'll take 22 grand of income and we'll take our dividend that way. And we'll get this RDTOH back then. So nerd toe, I love that word because it makes no sense, but refundable dividend tax on hand, we just have to issue a dividend when we are under this SIP, but I digress. Okay, so let's talk about the two different sort of taxes in a corporation. We either have active income in a corporation, or we've got passive income. On the personal side, that doesn't matter. Income is income. We pay tax on it. Active versus passive means, are we operating a business? So this one is really huge. If we are flipping a property, so we are buying it just to sell it, we're actively involved with flipping that property. It's never intended to be a rental, and our intentions were just to buy it, build it up, sell it right away. That is actually active business. And so if we're active business, that's a great place for taxes because we've got this frozen tax rate at 11%, so small business tax rate, and we can take that 89 cents on the dollar and invest it into the next flip, and the next flip, and the next flip, and the next flip. So, but other ways to get into active income is really, there's a couple specific ways, but we got to hire 5 full-time staff. So we got to have a lot of doors to make that happen. But if we had 5 staff, now we're into active business income and we're stuck with this 11% tax rate. So things are good. What else? We could have a related corporation. We could have maybe a real estate company that we're selling real estate, like one of these moguls. And then we've got a rental corporation here that needs to rent some space. So we might have from our operating corporation, rent paid over to a sister incorporation over here, an associated corporation. That's actually active business income because it source originated, whatever. We get into tax stuff there. But most of our income in an incorporated real estate piece is going to fall under this specified investment business income. One of the worst types of income. If you really want to fall asleep at night, go look up Income Tax Act, subsection 125, subparagraph 7, talks all about this type of investment business income. Now, what this is in an incorporation, the government doesn't really want us to just be buying properties, paying 11% tax, and then keep buying more and more properties and just deferring our tax ultimately until we die or our kids take over or whatever. So they've come up with this passive income or the specified investment business income that basically taxes us on our 10 grand here. It's going to tax us 48.67% or something. That builds what we call nerd toe, and that's refundable dividend tax on hand account. With this refundable tax, so of that 48%, 32% is refundable. So if we issue a dividend from the corporation to the shareholders, to the person invested, then we get all that 32% tax back. We're left over with this 16% corporate tax. Okay. Not bad, but then we've got to take this dividend. On this dividend in a 50% tax or $50,000 tax bracket, we're going to pay another 16.5% tax on that. So we're actually, no, 17.5. We're actually left off. If we have an incorporated, one real estate entity, 10 grand in it, 50 grand either way, we're left with, we could pay 30%, 30.5%. Personal tax if we owned it personally. If we go through here, we've got that 40%, 48% tax. We've issued a dividend, so we're actually only paying 16% corporate tax. But then we've got to take that income in personally. We're paying 33.5% sort of total tax on this 10 grand. So we're about 3% offside from having an equalized system. And that's, really, really important for us as far as a tax planning perspective. But realistically, if we just have one or two properties, incorporating them can actually be quite a detriment. But what about incorporating them into an operating company? If we have, already this consulting gig that we're doing, that we could incorporate that work, well, maybe that's better, right? Or maybe we've got a pile of money coming in from this corporate work into our active business, kind of like my business. All my money, comes to this David Sherwin Professional Corporation. And then I don't take all that money to live on personally. So I just take out what I need and I pay my dividends on that, but I've got excess cash up here in my corporation. So I don't want to take out 70 grand in order to, not pay fees or whatever and put the 20% down on this property. But I don't want to do that personally, because if I take 70 grand out of my corporation, I'm going to have to pay tax on that. So I'd much rather take that 70 grand from my corporation and buy this property corporately. And that's a reason I've just now deferred all this personal tax on this 70 grand. Yeah, I'm going to pay a slightly higher tax rate owning this property corporately, but I'm okay with that because I'm already taking a dividend. So I'm kind of fine with that, but I am kind of stuck with this 16% effective tax. But if I did it personally, then I'd be subject to whatever 36% tax, and I'd have to pay a pile of tax on that withdrawal and all the rest. So why wouldn't we incorporate some of these investment corps? Well, higher accounting fees, which sucks, right? You got to pay me to manage all of this and figure out what the best tax rates are. Corporate taxes are super complicated. We need better bookkeeping for them, so a lot more rules that way, and we just have a lot more tax planning to do. So there is higher accounting fees, obviously, to go along with incorporating some of this stuff. And yeah, using corporate cash to defer. I've talked about that. If we already have a corporation, that might be a reason why we would do that. Looking through my notes, I think that's kind of it that I really wanted to talk about with sort of corporate versus personally owned properties. So next one, I'll scroll down here. So just my tax news. That's me. I am the tax guy. Just going over some really big things here. Depreciation of real estate. Just be careful about that. There are options. I do have some clients where we're depreciating in real estate, and that is absolutely fine. Principal residence exemptions. We had to talk about this in one of the breakout rooms, and this is a super complicated thing. What we talked about in our breakout rooms is anytime you have a change in use of a specific asset. Say you're living in this place, now we moved on to a better place. We're going to keep this one as a rental. So nothing has happened. Nobody's sold this property. We still own it personally. We actually need to value that property. We've had a change in use from a principal residence exemption to now an investment asset. We've got to disclose that principal residence exemption. Thank you, Trudeau. And we've got to value it, right? So we got to know that it went from 300 grand to when we moved out, it was worth 472,000. That's all tax free. Now we've got this new investment asset with a tax book value at 472,000 that we get to grow and pay capital gains on. If we don't do any of that work, we don't have these valuations, we got to do it in hindsight. CRA could question our valuation methods, all sorts of issues. So main thing to think about here, if you have a change in use of the style of investment, talk to your accountant. Repairs versus capital, that's always a big one. So just kind of think about that. And we've just got so many different pieces of styles of tax on this. We've got our capital gains stuck at a 50% right now, could change. We've got active income. We've got terminal losses to take care of. There is a lot here. So reach out, have your accountant just kind of explain some of those things. Reach out to us. I am definitely here for you. I'm super glad to meet all of you, and especially if you're viewing online, thank you so much for taking the time. If you've got any sort of questions, I'm going to put my contact information in the chat. So I'll do that right now. And I just encourage you guys to reach out. If you've got specific questions, you don't need to be a client or anything like that. We can answer those questions with a quick phone call. We don't charge for that. It's just kind of fun, and it'd be a pleasure to meet you guys. So with that, I guess, that's it for me, Devin.
Thanks very much, David.
That chat kind of blew up, so.
There are some questions in the chat, so if you don't mind, I'm going to go through those over the next 5 minutes or so. So I'll just start from the farthest one back here. Do both partners have to be on title to be able to income tax split?
Not necessarily. Title. So the actual tax declaration of where we're going to pay the tax on this net income is all based on our intentions for the property, not necessarily to do with title. Title is our number one thing that we can just show CRA and be like, here's why we allocated it this way, right? So it's like super easy, straightforward. We can get around that. There has been court cases where, you weren't on title, but it was still 100% your property, especially in a married situation. Great question.
Yeah, thank you. That's thanks very much to Mina for that. Do you have to file each property separately, or can you just lump expenses and income together if you have, say, 3 rental properties?
CRA's tax guidance states that you should have multiple schedules for each rental property. Reasons why would be capital assets and sort of either grouping properties or not. What are some other reasons? I don't honestly know. I just know our guidance is to. So whenever possible, we would split that out. We'd have multiple spreadsheets, and we have multiple T776 forms. So in whatever software you're using, you would have T776 number 1 or number 2, and those all add up to the same place. So in general, it's likely not going to make much of a tax difference, but CRA does require it and asks for it if ever audited.
That's great. Thank you. Can I start depreciating my rental property after 5 years operating it as a rental property? Thanks, Javier, for that one.
Yeah, Javier. So this depreciation one, right? Just to be careful, sort of guidance on it. But so you basically, when you purchased it, or when that change of use happened, or whenever it became an investment property, at that point we would have a valuation done. We'd split between land and building. The building portion is automatically put into this capital cost allowance. And then we are basically electing to not depreciate this property. So any year you could depreciate it this year and then be like, next year you don't want to. Every year you depreciate it, it's going to drop that book value, only to when you sell it, that's a recapture of that book value. So yeah, every year you're actually making the election to not depreciate it. And that's how most of these systems are set up. So yeah, great question.
Okay, thank you. After you do renovations and increase the value of a property, can you sell it to yourself?
No, only on a change of use, right? So you can get a property revalued so that we can, get a higher mortgage on it. So we buy a property at 400 grand, fix it up to 600 grand. Now it's worth 800. There's no actual reason to sell it to yourself, tax-wise or other. You would just basically get a valuator out to value it at hopefully that 800 grand, and then we could take that to the banks and mortgage it. But that's kind of out of my realm, and I'll leave that to the Mogul group. But yeah, the only reason that we kind of sell properties to ourselves is a change of use of those properties. Even though no sale actually happens, we've got a tax transaction there.
Great, thank you. This one from Tracy. The ongoing question for all investors, when is it time to incorporate? What can you tell us in regards to deciding to incorporate or not?
An incorporation, like I stated, it depends on what we're doing with these assets. If it's active income and we're properly flipping these homes, maybe for a legalese reason, we want this liability of flipping homes to be in a separate entity, so it's not affecting our principal residents or our principal lives. So that might be one reason, to incorporate. But it's such a tough one to tell. If we've just got one or two properties, it's typically not a great reason to incorporate, because we're basically forced with that dividend, unless you're okay with a 48% tax rate. So if you are in the $400,000 north category on your employment income, yeah, you'd want to incorporate right away because 48% tax is what you pay. But apart from that, yeah, that's a very difficult question. I encourage you to reach out to me. I'd love to chat about it.
Great. Just take a couple more here. Is it true I can be a first-time home buyer after 5 years and get a GST rebate, even though I sold my first home 5 years ago?
The GST rebate rules, yes, I believe so, as long as it's under 360 grand or so. Those GST rebates are kind of falling away based on our house prices. But there is also another sort of rebate out there called the new home buyers credit. It's a $5,000 credit that goes on your personal taxes. Since it's a credit, it's only worth 15%, but it's a $750 credit. If you haven't owned a home in 4 years, you've been renting or you've been out of the country or what have you, make sure you trigger that credit. It's a free $750.
Great. If I buy a property that needs improvements before I rent, such as flooring, paint, new bathroom fixtures, and appliances, are these reno repairs or capital improvements?
I always thought they're reno repairs because it's like we're just replacing the paint, right? But no, CRA would see those as capital in nature because we're basically getting an asset ready for use. You buy a truck and you put a tonneau cover on it. The truck and tonneau cover are an asset. You buy a truck and then a year later you're like, I need a tonneau cover. Now that tonneau cover's repairs and maintenance. It's nothing capital. So it's kind of weird rules that way, but getting an asset for use is 100% capital, and it just adds to our book value of that house.